Welcome to the Financial Evangelist Podcast, your source for the latest in economics, crypto, and everything in between. From market movements to blockchain breakthroughs, we cut through the noise and bring you the facts fast.
Hey everyone, and welcome back to the Financial Evangelist Podcast. We're going to try to do a deep dive into all these economic tea leaves today to see if we can figure out if we are really headed for a recession.
Yeah, we've got a real mixed bag of signals to look at today.
Yeah, it's a real head scratcher.
Some point one way, some point the other way.
Right.
It's going to be interesting to see if we can make heads or tails of it all.
Yeah, let's kick things off with this consumer sentiment plunge, because this University of Michigan Consumer Sentiment Index, it really tanked like a whopping 22% since December.
Yeah.
And that's a pretty dramatic drop, wouldn't you say?
It is.
And what's even more interesting to me is that it's not just like, one political group or one demographic that's feeling pessimistic. It's like all over the board.
It is. And what's particularly interesting about that is that this echoes the sentiment in the lead up to the 2008 recession, particularly the rising concern about the job market. Despite some seemingly positive employment figures, people are worried about their jobs. And when people are worried about their jobs, they don't spend as much money.
Right.
And that can really have an impact on the whole economy.
So you're saying even if like the numbers look okay on paper,
right?
If people's gut feeling is like, things are going south.
Yeah.
It can actually kind of like...
It becomes a self-fulfilling prophecy.
Become a self-fulfilling prophecy.
Exactly.
Right.
Sentiment plays a huge role in these cycles because if people are holding back on spending because they're afraid they might lose their job, that can actually slow down economic growth and ironically make those job losses more likely.
It's like this weird feedback loop where like fear
absolutely
creates the very thing people are afraid of.
It does.
That's fascinating, but also kind of unsettling.
Absolutely. Now let's take a look at the stock market.
Okay.
While it has rebounded recently, the overall trend we're seeing is one of lower highs and lower lows, and that's a classic sign of a bear market.
Yeah. But we're also seeing like record highs in some sectors.
Yeah.
Right? So how do we square those two things?
You're right. Some sectors are defying the trend.
Yeah.
However, what's really telling is that big institutional investors like hedge funds, they're being very cautious. They're waiting for a clear trend reversal before they commit serious capital.
So they're kind of like playing it safe.
Precise.
Sitting on the sidelines until they
want to see what's going to happen.
Get a clearer picture of where things are going.
And this brings us to an interesting concept called passive bid. And this refers to the buying power of individual investors, folks like you, who are often driving market direction without the same level of analysis or risk management as those big institutions.
So you're saying it's like the everyday investors, like the mom and pop investors?
Yes, retail investors.
Who are kind of like keeping the market afloat right now?
They are a major factor right now.
That's both amazing and terrifying.
It really highlights the influence that individual investors can have,
right.
But it also raises questions about whether this rally is sustainable if the big players are holding back.
Okay, so we've got consumers who are feeling kind of gloomy.
Right.
We've got a stock market that's giving us some very mixed signals.
Yes.
What about the impact of tariffs?
Yeah.
Because this is a big topic, and we're not here to like take sides or anything.
No.
We really want to understand like how is this affecting people, boots on the ground.
Exactly.
And we found some data that shows that the impact of tariffs can vary pretty dramatically depending on where you live.
For sure.
So let's just take the example of the Canadian and Mexican tariffs, right?
Okay.
So a state like Montana that relies super heavily on imports from those countries, we're talking 93% import dependency. They're going to feel the pinch a lot harder than, say, Florida with its 14% dependency.
And that's a crucial point.
Right.
That emphasizes why it's so important to look at the impact of tariffs on a state-by-state level. Because, a blanket national policy doesn't account for the unique economic ecosystems of individual states.
Right.
So in a state like Montana, where there's such a huge reliance on imports from Canada and Mexico, those tariffs can really ripple through the whole economy,
right,
affecting everything from construction costs to manufacturing jobs to even consumer prices.
So it's not just about like some abstract national economic indicator. This is like about people's livelihoods.
Yeah, absolutely. A tariff that might have a negligible impact in one state could cause real economic hardship in another.
And this makes me wonder, are tariffs really an effective long-term strategy for boosting the economy?
That is a question economists are grappling with right now.
Yeah.
There's a lot of debate about the effectiveness of tariffs and whether they really achieve their intended goals without causing more harm than good.
Okay, so no easy answers there.
No.
Now let's shift gears a little bit and look at what's happening globally with interest rates, because it seems like central banks all around the world are slashing rates like it's going out of style.
It's a trend.
Switzerland might even drop to zero soon.
Yeah.
We're seeing similar moves in Canada. Sweden, even the European Central Bank is joining the party.
It's a significant shift from the normalization narrative we were hearing just last year. These aggressive rate cuts really signal a clear reaction to slowing global growth and the threat of deflation.
Right.
They're trying to stimulate their economies and prevent a downward spiral.
But here in the U.S., the Federal Reserve seems to be sticking to their guns, focused on inflation, resisting those rate cuts. Can they really afford to ignore what's happening globally? Are they maybe using these tariffs as a convenient excuse to keep rates higher than they should be?
That's a question a lot of analysts are asking. The Fed is walking a tightrope right now, trying to balance domestic concerns with these global economic headwinds.
Right.
It's a gamble.
Yeah.
Betting that the U.S. economy is strong enough to weather the storm and that inflation will cool down on its own without some drastic intervention.
But what if they're wrong? What happens if those global headwinds turn into like a full-blown economic hurricane?
Then the Fed might be forced to play catch-up, slashing rates aggressively to avoid a recession, and that could create a whole new set of problems, potentially leading to even more volatility in the markets.
Oh boy, okay, so we've got a lot of uncertainty on the global front.
We do.
Let's look at what the experts are predicting, because Goldman Sachs is ringing the alarm bells. They're warning about a potential market plunge.
Yeah.
Due to something they're calling machine-driven selling.
Right.
So what exactly is that, and should we be worried?
So machine-driven selling refers to the automated selling by institutional investors triggered by algorithms that respond to certain market conditions.
Okay.
So basically it takes human emotion out of the equation.
So we're talking about computer programs?
Yeah.
Making trading decisions.
Basically.
Based on some preset parameters.
Yeah. And it can be good and bad.
How so?
Well, on the one hand, it can reduce the impact of panic selling, when everybody gets scared and starts selling everything. But on the other hand, these algorithms can amplify market swings, so they can actually lead to those sudden dramatic drops that we sometimes see.
So it's like a double-edged sword.
Exactly.
It can stabilize the market in some situations.
But it can also make things more unpredictable.
Make it more unpredictable in others.
Oh, right.
And Goldman Sachs is worried that a bunch of things are kind of coming together at the same time, including corporate buyback blackouts.
Right.
That could trigger this wave of machine-driven selling.
Right.
And potentially lead to a very significant market downturn.
The big drop.
Wow. Okay, that's a sobering thought.
It is.
So we've got these algorithms, potentially driving a sell-off.
Right.
But at the same time, you have everyday investors.
Yeah.
Like our listeners who are maybe still holding on to that, buy the dip mentality, hoping to snatch up some bargains.
Yeah, hoping to get a good deal.
If the market falls.
Right.
So who wins in that scenario?
It's impossible to say for sure. But understanding these competing forces that are at play can really help us make more informed decisions.
So knowledge is power.
It is.
Especially in a volatile market like this.
Mm-hmm.
But not all the experts are predicting doom and gloom, right?
Right.
I was reading a report from Bank of America, and they actually see potential buying opportunities if the market does dip.
They do.
They seem to think this might just be a correction, not like the beginning of a full-blown recession.
It's true. There are different viewpoints out there, and it's important to consider all of them before making any investment decisions.
Yeah.
We're in uncharted territory here, and nobody has all the answers.
So we've covered a lot of ground already. We've talked about consumer sentiment.
We have.
The stock market tariffs, global interest rates.
Yeah.
Even expert predictions.
A lot to digest.
It seems like there's just a ton of uncertainty out there.
There is.
But before we get into what all of this means for you, our listeners,
right,
and what steps you can take to kind of navigate these choppy waters, we're going to take a quick break and come back with part 2 of this deep dive.
Sounds good.
So stay tuned.
We'll be right back. As we talk about all these market swings and potential plunges, I can't help but think about the role technology plays in all of this.
Right.
We touched on Goldman Sachs' warning about this machine-driven selling.
Right.
It makes you wonder, are we kind of handing over too much control to the algorithms?
Right. It's almost like something out of a sci-fi movie. Yeah. You know these computer programs that are like making these split-second trading decisions that can send these ripples throughout the entire market? It's a little unnerving.
It definitely adds a layer of complexity to an already intricate system.
Right.
But, to be fair to the algorithms, they can bring some benefits, too.
Okay.
By taking human emotion out of the equation, they can help to mitigate panic selling, and they can potentially even spot opportunities that human traders might miss.
So they can be a stabilizing force in some cases, but also potentially exacerbate volatility in others.
Exactly, and that's why transparency and regulation in this world of algorithmic trading are so crucial.
Yeah.
We need to make sure these powerful tools are being used responsibly and that there are safeguards in place to prevent them from causing widespread instability.
All right. Okay, so we need to keep a close eye on the algorithms.
We do.
Make sure they're playing nice now. Let's circle back to those global interest rate cuts.
Okay.
Because it's a fascinating divergence, isn't it?
It is.
While a lot of these central banks are slashing rates to try and stimulate growth, the U.S. Federal Reserve seems to be holding firm, focusing on inflation.
Right.
But you raised an interesting point earlier. Are they maybe using tariffs as a smokescreen to justify keeping rates higher than they should be?
Well, it's certainly a possibility. The prevailing narrative is that the Fed is primarily concerned with inflation.
Right.
And they've pointed to tariffs as a contributing factor to those rising prices. But if the rest of the world is cutting rates to spur their economies, can the U.S. really afford to go it alone?
That's the billion-dollar question, isn't it? What are the risks if the Fed miscalculates and keeps rates too high for too long?
Well, the biggest risk is that they could stifle economic growth and actually push the U.S. into a recession. If borrowing costs remain high while the rest of the world is easing monetary policy, it could make American businesses less competitive, and that could put a damper on investment and hiring.
So it's a bit of a gamble then.
It is.
They're betting that the U.S. economy is strong enough to withstand those global headwinds and that inflation will eventually cool down on its own.
That's the bet.
Okay, so the stakes are high now. Earlier, we talked about how the impact of tariffs can vary dramatically depending on where you live. And you highlighted the example of Montana, which relies heavily on imports from Canada and Mexico.
Right.
Are there other states in similar situations where those tariffs are having a disproportionate impact?
Absolutely. Any state with a high dependency on imports from countries targeted by tariffs is going to be more vulnerable to the economic consequences. Think about states with strong manufacturing sectors that rely on imported raw materials or components.
Okay.
Those businesses might face higher costs, which could lead to job losses or price increases for consumers.
So it's not just about the direct impact on those specific goods being targeted by the tariffs, but the ripple effect throughout the whole state economy.
Exactly. Those tariffs can have a cascading effect, impacting businesses and consumers in ways that might not be immediately apparent.
Wow.
And that's why it's so important to look beyond the national headlines and understand the regional nuances of economic policy.
It really highlights the interconnectedness of everything, doesn't it?
It does.
How a decision made in Washington can have a direct impact on the lives of people thousands of miles away.
Absolutely.
Okay, so we've established that tariffs can have a significant impact on certain states.
They can.
But let's zoom out a bit and look at the bigger picture. Do tariffs actually achieve their intended goals? Are they really bringing back jobs or boosting domestic industries?
Well, that's a question that has sparked a lot of debate among economists, I bet.
There are valid arguments on both sides, and the evidence is often mixed.
Okay, well, let's unpack those arguments then.
Sure.
What do proponents of tariffs say? What are their main points?
So proponents of tariffs argue that they level the playing field with countries that engage in unfair trade practices. Things like dumping cheap goods below market value. They also say that tariffs protect domestic industries from foreign competition, allowing them to grow and create jobs.
So the idea is to create a more favorable environment for American businesses and workers, shielding them from being undercut by these cheaper imports.
Exactly. By imposing tariffs, they aim to make domestically produced goods more competitive and encourage companies to invest and create jobs here in the U.S.
Okay, that makes sense from a certain perspective. But what about the potential downsides? I mean, there must be reasons why economists are so divided on this issue. Oh, there are definitely potential downsides. Critics of tariffs argue that they ultimately raise prices for consumers, they stifle innovation, and can even lead to retaliatory tariffs from other countries, escalating into trade wars that harm global economic growth.
So the classic trade-off then, potential benefits for some industries and workers.
Right.
but potential costs for consumers and the broader economy.
Precisely. And the ultimate impact of tariffs often depends on this complex interplay of factors. The specific goods being targeted,
Right.
the elasticity of demand, the availability of domestic substitutes,
Yeah.
the response of other countries. All of these things come into play.
It sounds like a real economic puzzle with no easy solutions.
It is a complex issue.
But one thing that's clear is that tariffs are a powerful tool that can have both positive and negative consequences.
They can.
And their effectiveness really depends on how they're implemented and the specific circumstances of the situation.
You've hit the nail on the head. It's not a black and white issue. There's a lot of nuance involved. And understanding those nuances is crucial for making informed decisions about trade policy.
Okay, so we need to move beyond the simplistic rhetoric and really dig into the data to understand the complexities involved.
Exactly.
And speaking of data, one thing that stood out to me in our research was the role of technology in amplifying market volatility. We talked about machine-driven selling, but there are other technological factors at play, aren't there?
Absolutely. The rise of high-frequency trading,
Right.
where algorithms execute trades at lightning speed based on preset parameters.
Right.
This has significantly increased market volatility. These algorithms can react to news and market movements in milliseconds,
Wow.
often leading to these rapid price swings that can be really difficult for human traders to keep up with.
So it's not just about the machines making the trading decisions. It's the speed at which those decisions are being made.
The speed is a huge factor.
Yeah, it's like the market is moving at warp speed.
It is.
And it's harder than ever for individual investors to kind of keep pace.
It can be challenging.
Okay, so we need to be aware of these technological factors at play,
We do.
but also stick to our long-term investment goals. But let's be honest, it's easy to get overwhelmed by all this information.
It is.
We've got consumer sentiment, market volatility, tariffs, global interest rates, and even algorithms running amok. How can our listeners, everyday people who may not be financial experts, actually apply all of this to their own lives?
That's a great question, and it's important to remember that you don't have to be a Wall Street guru to make smart financial decisions.
Right.
The first step is to simply be aware of these larger economic forces and how they might impact your personal finances.
Okay. Awareness is key. What else can people do?
Well, instead of getting caught up in the day-to-day fluctuations of the market, focus on your long-term financial goals.
Okay.
Are you saving for retirement, buying a house, putting your kids through college? Having clear goals will help you stay focused and make investment decisions that align with your priorities.
So it's about having a plan and sticking to it even when the market gets a little turbulent.
Exactly. And as part of that plan, make sure you're diversified.
Okay.
Don't put all your eggs in one basket.
Right.
Spread your investments across different asset classes, industries, geographic regions that way. If one area of the market takes a hit, your entire portfolio won't be wiped out.
Diversification. That's the classic advice we hear all the time.
Yeah.
But it's easy to forget when you're feeling a little anxious about the market.
It's true, but it's one of the most effective ways to manage risk and protect your long-term financial well-being. And remember, you don't have to go it alone. There are resources available to help you, like financial advisors, online communities, even educational podcasts like this one.
Right. There's a wealth of information out there, and it's never been easier to access it.
Absolutely.
But sometimes having like a knowledgeable guide can make all the difference.
For sure, don't be afraid to seek out expert advice, whether it's from a financial advisor or someone you trust who has experience in investing.
Okay, so we've covered a lot of ground today.
I have.
We've talked about the economic indicators that are flashing some warning signs, the global forces that are shaping the markets,
Right.
and even the role of technology in amplifying all this volatility.
A lot going on.
But before we jump into the final part of this deep dive, where we'll explore some potential strategies for navigating these uncertain times, we'll take a quick pause. So stay tuned for the conclusion of this episode of the Financial Evangelist Podcast. Welcome back to the Financial Evangelist Podcast. I hope that even though we've been going over all these economic indicators that seem a little unsettling, you're starting to see by now how understanding these trends can actually help you make better decisions, even the ones that seem kind of scary.
Exactly. It's kind of like getting a behind-the-scenes look at how this whole financial world works. Once you see the gears turning, you can start to get a better sense of where things might be going.
Yeah, it's like when you learn the magician's secrets.
Right.
The trick isn't so mystifying anymore.
Exactly.
Speaking of secrets, one thing that's become really clear in this deep dive is that the financial world, it's anything but simple. This isn't just about, stocks going up or down.
No.
This is like an intricate web of all these different interconnected systems.
Yeah.
You've got consumer behavior, global trade, technological advancements, even like geopolitics, all mixing together.
It really is like this giant ecosystem. Everything is connected in ways that we might not always see on the surface.
Right. You can't just focus on like one piece of the puzzle.
No.
You have to look at the whole picture.
You have to see the big picture.
So this is like that butterfly effect thing, right?
Yeah.
Like, a tariff on steel in one country
Right.
could end up affecting the price of bread in another country.
It's all connected.
It's all connected, but how do we as, individual investors actually make sense of all this complexity?
Right.
Because it's really easy to feel overwhelmed and just want to, bury your head in the sand.
It's completely understandable to feel that way.
Right.
But here's the thing. You don't need to become an expert in like every aspect of finance to make smart decisions. To start with the basics, what are your financial goals? What's your risk tolerance? Once you have a clear picture of your own financial situation, you can start to navigate these larger economic trends more effectively.
Okay, so self-awareness is key.
Yes.
Know yourself, know your goals.
Right.
But then how do we actually apply that knowledge to this, crazy interconnected financial ecosystem we're talking about?
Well, think of it like building a house.
Okay.
You wouldn't just start throwing bricks around randomly, would you?
Hopefully not.
You'd have a blueprint.
Right.
A plan. A plan, the same applies to your finances. You need a solid financial plan that outlines your goals, your risk tolerance, your strategy for reaching those goals.
So it's like a roadmap for our financial journey.
Exactly.
But what happens when we hit a detour? Like a sudden market downturn or a home trade war breaks out.
Yeah.
Do we just abandon the map and start driving in circles?
No, that's where flexibility comes in. Your financial plan should be a living document, something that you can adjust as circumstances change. The key is to have a framework that guides your decisions, but also be open to making adjustments along the way.
So it's not about setting like a rigid plan in stone and never deviating from it.
No.
It's more about having some guiding principles that help you navigate all the twists and turns.
Exactly.
Yeah.
And within that framework, diversification is your best friend.
Okay.
We've talked about this before, but it's worth emphasizing. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographic regions.
Diversify. Got it. But what about those of us who are maybe feeling a little paralyzed by all this uncertainty? What's the best course of action when you're just not sure which way to turn?
The worst thing you can do is make impulsive decisions based on fear or panic. Take a step back. Breathe. Remind yourself of your long-term goals. And remember, you don't have to go it alone. There are resources available to help you, like financial advisors or even trusted friends or family members who have experience in investing.
Yeah, sometimes just talking it through with somebody you trust can really help you gain some clarity and perspective.
Absolutely.
And let's not forget the power of knowledge.
Right.
The more we understand about how this whole financial world works,
Yeah.
the less intimidating it becomes.
For sure.
And there's no shortage of information out there these days.
Not at all. We're living in the information age.
Right.
There are books, articles, podcasts like this one. You have access to so much knowledge right at your fingertips.
So don't be afraid to do your research. Ask questions and keep learning. The more you know, the more empowered you'll feel to make those financial decisions.
And remember, it's a journey, not a destination.
Okay.
You don't have to have all the answers right away. Just keep learning, keep growing, and keep adapting to this ever-changing financial landscape.
Well said. And that's really what we're all about here on the Financial Evangelist podcast, empowering you with knowledge, encouraging you to think critically, and helping you navigate this complex world of finance. We hope this deep dive has given you some valuable insights and tools to help you on your financial journey.
Absolutely. Remember, stay curious, stay informed, and don't be afraid to ask questions. And most importantly, don't panic, even in times of uncertainty. There are always opportunities out there for those who are prepared and informed.
That's a great note to end on. Thanks for joining us for this deep dive into the economic waters. And we'll see you next time on the Financial Evangelist podcast, where we'll continue to explore this fascinating world of finance.
Tired of spending countless hours sorting through your crypto transactions? Meet Coinly, your all-in-one crypto tax solution. Whether you're trading, staking, or mining, Coinly automatically imports and categorizes your transactions from over 700 exchanges and wallets. Generate accurate tax reports in minutes, track your portfolio performance, and stay compliant with your local tax authorities. Coinly supports tax regulations in more than 20 countries, making crypto tax season stress-free for investors worldwide. Join over 1 million users who trust Coinly with their crypto taxes. Visit the link in the description to get started today and receive 20% off your first tax report.